And are we back? All right, I think we're back. Basically, OBS crashed on me. First time technical difficulties, we'll just say. Welcome back to the party, everyone. So, ask me anything. This is just for fun kind of thing. I'm just testing out all the little features we got here. I've literally never played with any of this stuff before. I just got permission from YouTube to be able to live stream, so like a kid in a candy store, basically. Don't overthink it. Just letting Discord know what happened. Now I wonder how I fix it. I'm getting a bitrate warning. So, I don't know. I threw a Q&A up there and didn't get any questions, so I'm assuming that didn't work. But I'm kind of relying on you guys to tell me if like the connection seems choppy or if it's good. I only want to iron the bugs out once. Oh, sorry, sorry about that, Matt. Actually, Matt, if I put it back up, will you just put it in there? I just want to see what it looks like. I had kind of assumed it wasn't working, so... But that was a good question, though. So, Matt asking $100,000 in a single investment. Thoughts? I think if that's all you've got and it has to go in a single investment, I think it has to be an ETF. I don't think you can really. I don't think you could really. Don't think you can really risk everything into one stock if that 100K is all you've got. And you said that he was 68, so I would assume income would be the objective there. So you could do something like SCHD, or if you want more income and you're okay with the covered call strategies, maybe JEPI. Let's see. NYCB. Well, high yielding New York Community Bank Corp, huh? So I've never heard of this bank before, but I'll tell you where I'll start. We'll look at the market cap, and we're going to see if we can find their investor relations. There we go. Now, let's see. Well, just looking for their... Oh, there we go. What I want is... I want an actual 10K, most recent. And then we want to see if we can find their balance sheet. Financial statements and supplementary data. Let's see, we got an income statement. Yeah, this is super exciting. Cash flow statement. So basically, I'm looking for their book value. And yes, these 10Ks are basically like a giant, really, really boring novel. Let me just see if I can... Yeah, even just searching balance sheet doesn't actually get it necessarily. And usually I would actually already have found it before I would start recording anything, but since I got asked... Okay, so that didn't find it. Yeah, that's super annoying. I'll go back to the table of contents. Let's see. Okay. So, statements of condition. I mean, it looks like maybe that's where they've decided to put it. I don't know why they're calling it that and not a balance sheet, but here we go. All right, so you've got total stockholders' equity of a little over or a little under $9 billion, right? So that would essentially be their book value. All right. And their market cap is a little under $6 billion. So they're at potentially a small discount to book value. But then if you wanted to use the actual value investor metric, you would want to subtract the goodwill, which is over $2.4 billion, and any intangible assets, which I think maybe they just have. I'm not seeing anything listed as intangible assets, but you would still need to get rid of intangible goodwill, and you would also need to get rid of the preferred stockholders' equity to get the tangible book value. And I think when you do that, they're trading basically right at tangible book value. So it's not really at technically at like a discount for a bank, but you could say, hey, I mean, it's a mid-single digit PE, high dividend yield. But the other thing I would look at probably, all right, the cash and equivalents of about $2 billion compared with the total deposits of $58 billion. So the thing I would be asking is, hey, what kind of customers does this bank cater to? Because the cash and equivalents compared to the deposits, a little bit thin. You know, they've got 30 times almost more deposits than they've got cash and equivalents. Okay, so if they've got the wrong kind of investor in depositors, like Silicon Valley had mostly like tech startups, so they didn't have a lot of regular everyday people depositing in the bank, right? So they had all of these clients with tons and tons, millions and millions of dollars in their accounts. So if just a few of them pull out and they don't have a lot of cash to cover it, that becomes a problem. Now, if this bank more caters to like typical everyday people, having a little bit less cash isn't too big of a problem, because it would take a lot of people coincidentally deciding to pull their money out at the same time to cause like a bank run or something like what you had with Silicon Valley. So that's one of the things you want to understand about this bank. And, you know, I don't think we have time to like read through the whole 210 pages here on the stream and like really get into it. But, you know, it could be an okay buy, honestly. TRMD and TIO, huh? All right, well, let's take a look. I've never heard of this before. So, United Kingdom, capital region of Denmark. What does TRMD do exactly? We gonna go to their website real quick. Torm. That would be a cool name. Something. So that would literally be like the first thing I would answer is what the heck do they do? Mainly because in every 10K, you'll see things like risk factors, right? And if you don't know what a company does, it's really hard to know like which of those risk factors like actually affects them, because they pretty much have to cover all their bases. So you're gonna see random stuff like, oh, like if if there's a great flood, or if an asteroid hits, or if there's another 9/11, or any of those kind of things, people will literally put like all that stuff in their 10K as risk factors. Like okay, yeah, if an asteroid hits the planet, that's going to be bad for pretty much every stock, I would think. But they do it because you get those anytime a stock falls a lot, you get those news articles that are put out, those press releases saying, oh, there's a class action suit against this company because they misled shareholders. What they'll try to do is say that the company did not disclose risk factors adequately in their filings, and basically say, well, this thing happened, the stock went down, and they didn't say that could happen in their 10K, therefore they're committing fraud, basically. Now, you can't really know which of those risk factors is going to be like particularly impactful to a specific business unless you know what the heck they actually do. So let's answer that question first. Product tanker company, huh? It's interesting. So looks like it's maybe it's sort of like Zim. Maybe it's but they move specifically petroleum products, gasoline, diesel, jet fuel. That could be interesting. Yeah. So yeah, they're not. So Zim is mostly like regular shipping containers, whereas these guys, it's energy products. So basically petroleum and that kind of thing. I've honestly never heard of this company before. And what was the other one? TIO. That one sounds familiar. Tingo Group. All right, so this is kind of penny stock territory, huh? So, Eagle Eye, with anything that's in the sort of shipping or moving of commodities, I would just keep in mind that temporarily, if people are anticipating economic cool down, that can really affect all shipping type things, and it could be that you have an opportunity to get it at a discount at some point in the near future if the recession stuff plays out the way people think it will. But it's also true that fossil fuel companies, like energy companies overall, like Chevron, big gains recently. Warren Buffett, of course, kind of, they call him the Oracle, and he saw it ahead of time and got in before the big run up. At this point, energy is a bit at a high, I would think. So I don't like getting in on stuff after it's kind of already caught on. I think the opportunity is past if people are already really, talking about it. So what's this Tingo company do? Fintech and agri-fintech, huh? Global fintech and agri-fintech. I don't even know what agri-fintech is. So I would not I would not feel terribly competent to judge this. Leading agri-fintech company operating in Africa. Okay, so this is sort of an emerging market play, I guess. Betting on the future growth of the economy on the African continent. Interesting. I would think in the coming years, a lot of companies will probably try to capitalize on that because Africa is basically, it's sort of like almost the last frontier. It's got the most probably untapped economic potential of any of the continents in the world at this point. China's pretty well got a grip on the Asian economy, so maybe I only see Africa here, but maybe so. However, keep in mind, China's got a pretty big grip on Asia, so Chinese companies, and I don't know where is this company headquartered in New Jersey. Yeah. So I wouldn't necessarily bet on them to outcompete China and their companies in the Asian market. Like I went to the Philippines last year, and every ATM was a China bank ATM. It wasn't the only airline flying there, but the one with the most available flights out there and back, China Airlines. Okay. It's just, China is basically, taking their piece of the emerging Asian market pie. All right. But yeah, Africa is definitely still the untapped frontier. Now, China is trying to exert their influence there too, but I think there's more untapped potential there to take advantage of probably than Asia at this point. China being the preeminent, regional grand, great power over there economically. So NYCB has also acquired assets of the now failed Signature Bank. That's interesting. So, Jose, that is interesting because they probably were able to get those assets at a pretty nice discount. So that could end up being good for New York Community Bank investors. We probably won't know until their next earnings, like what that actually looks like as far as, whether it increased their book value or not. But if you think that the market isn't accounting for that information, and you think that the fact it's kind of roughly at tangible book. I mean, I didn't go through the calculation on it, but I think that you have to look at where it's trading right now and what you think the effect will be on their book value, upcoming. And if you kind of do the mental math on that and you think, hey, this could be an opportunity to capture that gain in book value at a discount to myself today in the current share price, yeah, I mean, that makes sense why you'd be interested. So I want to go at least 30 minutes on this thing. So, if nobody has anything else, I do want to say we're getting pretty close to that point where I'm going to have to do $500 worth of stock in the YouTube portfolio. I was just recording something about that before I started the stream here. What do you guys? What are some initial thoughts on what you think we should buy at 500? So, Jose, on the Bed Bath & Beyond reverse stock split, yeah, this is just something so that they can basically issue more shares, because their share issuance, it's in there where they can only issue more stock onto the open market if they're over $1 a share. And last I checked, they were at like 30 cents or something. So it's just a move so that they can dilute shareholders even more and just fund operations off of people basically hoping for some short squeeze that's probably not going to happen. Oh, MPW. So, okay, those lawsuits. So remember earlier I was talking about how if somebody has, risk factors on their 10K and maybe there's something that they didn't list on there and then the stock loses a bunch of money, they have all these lawsuits and things on the press releases. So that's kind of what that was about. So these are popcorn headlines, okay? Now, there are, I guess, what you would call parasite type law firms out there that, all right, so Frank R. Cruz. I wonder what would happen if we Googled this guy. The law offices of Frank R. Cruz. Because, all right, they're all on Global News Wire, Business Wire, Global News Wire. My understanding is you can pay to have your headline go up on here. So, I'm just, I'm just curious. Wow. See, he's announcing a lot of investigations and class action lawsuits against a lot of different companies, it looks like. Wouldn't you know? I bet if you looked at these, they all lost a lot of share value right before he filed all of these lawsuits. Isn't that funny? So, yeah. So this is basically the stock market equivalent of an ambulance chaser lawyer, in my opinion. Okay? Don't come at me, Frank R. Cruz. So, yeah. It's not like this is the only, MPW is not special in this, okay? They had a big, fast, sharp drop in their share price, and suddenly they're being investigated, and some law firm is trying to rabble-rouse a you know, a class action suit. And yeah, you're going to find some disgruntled, you know, shareholders who feel like they're holding the bag, and, you know, they want to say that, you know, management, you know, committed fraud or was not really trying to make money and was doing shady stuff. The truth is, you know, MPW management is legitimately trying to run MPW like a business and return value to shareholders. Now, whether they succeed or not, well, that's the risk you take when you're an investor, okay? So anybody that wants to, you know, go out and, you know, be a part of that lawsuit, it's sour grapes, okay? And honestly, my guess would be that the attorney just wants to get enough shareholders interested in it so that MPW will pay them something to go away. And, you know, when the lawyer is probably doing it on contingency, so they just want, you know, their percentage of that to be enough for it to have been worth their while to put out all these press releases and, you know, actually file the suit in the first place. I don't think it's actually that this is some great advocate of, you know, wronged shareholders or anything like that, okay? Because frankly, like, I'm an MPW shareholder. I don't feel that management has, you know, misled me in any way. You know, granted, like, hey, if the SEC starts investigating them, I might be a little bit, you know, I might be a little concerned at that point that there's something actually going on here. But, gosh, what was it? There was one company where somebody had a gotcha on YouTube, and it might have been MPW. Like, they found a typo in their 10K or something. And it's like, yeah, a typo in the 10K. Got them. The 10K, like I said, it's like a novel, okay? It's like 200-something pages. I'd be shocked if you read the whole 10K of any company and couldn't find, like, one typo somewhere in there, you know? Just kind of ridiculous. But yeah, I wouldn't take any of these, you know, Business Wire, Globe News Wire, whatever type headlines too seriously. I mean, right away, you Google the lawyer and you see that this is just just pages after pages after pages of it, okay? This is just what they do, all right? Yeah. So, Jose, yeah, I definitely think shareholders should be avoiding the noise. And yeah, if you think that this is what's driving the share price down or keeping it low more so than the actual performance of the company, yeah, I mean, be like, hey, thanks for the discount, Frank. You know? Yeah, personally, I have a pretty full position, but, you know, if it were to collapse even lower, but nothing really fundamentally changes about the financials of the company, yeah, I would definitely, you know, I would think that I would have to stick with my convictions and average down at that point. Though I do admit that's kind of hard to do when, you know, when you have to look at that red in your portfolio every day, right? But, you know, that's where your temperament, your emotions come in. You do have to separate your feelings about seeing red from the actual actions of what you do in your portfolio. Ooh, 2.4 stars. Yeah, I'd give him 0 stars if I could. So, honestly, before we get off, I do want to ask you guys, when we do the 500 for the YouTube portfolio, what do you guys want? Like, if you were going to pick it today, what stock would you choose? Dividend payers over $1 billion in market cap. My boy Eagle Eye, MPW. All right, let's go. Although I honestly feel like I already have 1,100 shares of MPW, so I feel like, you know, I've got MPW pretty well on lock. But hey, if that's what people want, then that's what the people want. Union Pacific got a lot of interest last time. eBay is interesting. You know, funny thing, they used to own PayPal and they spun it off. Like, honestly, man, if I kind of wish eBay would be so much more interesting if they still had PayPal. I like PayPal. I have sold puts on it in the past. Didn't get exercised, but ARCC, Ares Capital. Okay. Yeah, they're a pretty interesting BDC. Have a really high yield. BNL, never heard of that one. Broadstone Net Lease. Hey, I like boring businesses. So yeah, here's the thing. I was selling puts on Meta when they were like $90. Okay, it was. I mean, people were just having the most absurd ideas about how Meta was, their heyday was coming to an end, and they're a garbage company that's going to zero. Meanwhile, if you look at their financials, they basically just print money year in, year out. But people didn't really like the legs of the Zuckerberg avatar in the metaverse, therefore the price had to crash. It's stupid. So yeah, like I love Meta as a business, but I'm only really interested when it's at a steep discount. I think I'll get another chance in the future. Comcast, oh my gosh, yeah. As if anybody, this might reveal my age a little bit, but if anybody here is a fan of the movie The Cable Guy, it's the information superhighway, as Jim Carrey says. So no, I don't. I don't have DRIP activated. No dividend reinvestment plan. The dividends just go towards the cash, and I do every purchase manually, or in the case of accounts where I write options, I do all of that manually, and then redeploy that cash hopefully in. But I don't really like automating anything. I'm kind of weird like that. If I just had like one ETF or something, yeah, I'd probably turn on dividend reinvestment. If I'm buying and holding one ETF, whether it be SPY or SCHD or JEPI or whatever. The dividends do eventually end up, getting reinvested, but only when I pick something to invest into. So what kind of REIT is BNL? Oh, they're pretty well diversified. 804 properties, a lot of different. So, are they? I was almost going to compare them to Stag because they've got 51% industrial, but they've got some healthcare and retail and office as well. I do like that office is the smallest portion, just because like office REITs are just, that's tenuous, right? With how, like, so I mean, yes, employers are bringing people back into the office, but there are still quite a few that are like a little more flexible about work from home. The actual need for office space has decreased some. Well, digital. The question is, you know, are we going to even be able to look at what his portfolio is, or is he going to hide it behind a paywall? I don't know. But I have an idea of what he's got, and I'm sure we'll crush it. I mean, what's he gonna do? Beat us with Tesla and Tattooed Chef? And by the way, that's not anything against Tesla as a business. They do what they do very well. It's more of a criticism of the valuation that people give. I firmly believe that it's possible to overpay for a good company. I mean, that's why I'm not just buying Apple constantly, right? But yeah, I definitely. This is an interesting. This is an interesting asset mix for this REIT. All North America, 221 tenants, 804 properties. Yeah, I mean, it does seem like, they probably have a pretty low risk overall of like again for as far as tenant risk, right? Coca-Cola Consolidated Inc. Do you know the ticker for that? I mean, it's technically a dividend stock, I guess. 0.37% yield. Okay. It's an independent bottler of Coca-Cola. Yeah. So I think that's something people don't realize about Coca-Cola. They don't do all of their own bottling. In a lot of cases, yeah, they're just they're basically the biggest value in Coca-Cola, I think, is just the name Coca-Cola, the brand. I mean, as a lot of you know, I'm pretty much personally responsible for all the dividend increases they've had over the last 5 or 6 years because of how much Coke Zero I drink. I'm hopelessly addicted. Daddy Buffett can thank me in his annual meeting of Berkshire shareholders. But yeah, if you're worried about your year to year performance and you're worried about a recession and all that, yeah, anything related to consumer staples is probably going to have the least negative impact to it. So your Coca-Cola and even related companies like this, your yeah. So that's the thing. People think it's it's they think that there's some kind of magic when it comes to Warren Buffett, but all he really did was say, "Hey, here's a great business, and it's kind of cheap right now. I think I'm just going to buy it and hang on to it for a few decades." And that's where the majority of his net worth came from. It wasn't any kind of like, 4D chess rather, master, trading strategy. He doesn't even look at, technicals or anything like that. The dude just says, "Hey, this is a really good business. This is a pretty good price. I'm going to just buy a lot of it and just hang on to it like it's my firstborn child and never let it go." So, Matt, a good investment to buy, I don't think the amount of cash you have really is a factor there, right? So the way you value a company, whether a company is a good value or not, isn't determined by how much cash you've personally got to deploy, okay? Now, the only way that cash kind of comes into play is if you like to use options, because you need lots of 100 shares or enough cash to buy 100 shares to use options. Now, let's see, market review of consumer and commercial products. Okay, so again, this is, okay, Newell Brands, all right. Actually, I'm just going to look at what some of their products are to see if they're comparable to P&G. Okay, X-Acto, Sharpie. I recognize some of these brands. Crazy Glue. Okay, Rubbermaid. Not bad. Oster, Mr. Coffee. Yeah, so these are brands you will see in pretty much every household in one way or another. So, baby brands. Like those, people will always spend money on their infants. So I wouldn't necessarily maybe compare them to P&G exactly. P&G is they've got so many different things under their umbrella, but yeah, this is a pretty solid consumer brands business. But I mean, they are basically like a mosquito versus an elephant compared to P&G. But like valuation wise, I mean 26 PE, which okay. It's really unusual to see that high of a PE with that high of a dividend yield. So I'm guessing maybe they had a write-off or something in their cash flow. Their price to free cash flow is probably a little bit more reasonable. But that would just be like my guess, because otherwise I would expect their payout ratio to be really stretched. Because if you have like a 26 PE, if you've got a 4% yield, you're at like 100% payout ratio, basically. You're looking at the financials already? Yeah, so when it comes to how much cash you have, though, so yes, you wouldn't be able to get as many shares of P&G, but like if you just look at the PE for valuation, it's basically the same value. But Newell has a much higher dividend yield, which makes me wonder. Okay, there. Since we know that their earnings probably isn't covering, unless it's we look at maybe adjusted earnings or cash flow. Really, I would want to look at the free cash flow, because how they're getting such a high yield with also such a high PE is okay. So so some people have looked at the financials and yeah. I'm gonna trust that there's some red flags in there. So I it could be that Newell is maybe a little bit of even a yield trap. Granted, I'm not saying they're going anywhere, but I would say if that dividend isn't really well covered by either their earnings or their cash flow, that they are potentially looking at a cut. In fact, actually, why don't we, just to illustrate the point on that, if you pull them up on, okay, so this is what I was trying to explain earlier. It's just easier if I pull it up on here. So, trailing 12 months earnings, 47 cents per share. Forward dividend, 92 cents per share. So unless there was a one-time expense that they can adjust for, or it was there was some kind of a paper loss and their free cash flow covers it, I would be worried about their ability to pay that dividend, just on the surface, right? But yeah, John, it's definitely there's definitely some red flags with NWL. On the very, very surface, it doesn't look like a sustainable situation with the dividend. I think it was the company that Carl Icahn had a stake in. Yeah. So Matt, I would definitely, I would learn to look a little bit at some of the metrics, right? And I would let that dictate what's a better value, more so than, because I feel like you're looking at, hey, somebody's got, a small portfolio. Should I be looking for cheaper share prices? But the share price only really so Procter and Gamble. All right, so Newell Brands, 1242 on the share price, right? Now, so Procter and Gamble could do a 10-for-1 stock split, and suddenly it would be $15 a share. But that doesn't change the market cap. Okay, the share price and the market cap they're only related in the sense of if the actual stock price moves up because of buying or selling, right? But the actual indicator of how much profit you're buying per dollar is basically expressed by the PE. So the PE basically tells you how many dollars you have to spend to buy $1 of earnings, okay? And that's like pretty much the most basic valuation metric that there is, because at the end of the day, you're trying to buy companies that generate profits, and you should value it based on how expensive it is to buy your piece of those profits. The share price in and of itself doesn't actually really matter. I know that, like, what you see a lot of the time is, oh, they're down, therefore that's bad. That the fluctuations in the price, I don't really care so much. What I care about is if it falls enough to where I get a more reasonable value. Can I buy that dollar of earnings for less than this? That's what I care about. Assuming that the actual profitability isn't dropping along with the share price, right? So, yeah, that's a good point. So you can't just look at the PE snapshot one day, 1 year, and say, hey, it's got a 25 or a 30 PE, therefore it's expensive, right? So I think it's important to look at their adjusted EPS, understand what they adjusted it for, and also the free cash flow. I think if you look at those things and it tells you a consistent story, then you kind of have a starting point, right? Like, one thing I would just point out. So I've been selling puts on Comcast, but according to just the PE, because this is based on straight earnings per share, not adjusted, not free cash flow, it looks expensive. However, their adjusted EPS is like 3 times what the basic EPS is, okay? That means that their adjusted EPS is, oh gosh, what was it? It's like $3.60 or something like that, compared to like $1.20 or something like that of just straight up EPS. And so on that basis, the price you would pay for adjusted earnings per share, it would be more like a 10x multiple rather than a 30x, right? That's right. So yeah, the market cap is how the market is actually valuing the whole business, right? So that going up or down is what effectively changes what you're paying for the company, right? So if you buy shares of Comcast today, you're valuing the whole company at $160 billion. And that's really what you're trying to evaluate when you're trying to figure out what you want to pay for a stock. You're figuring out if this market cap number reflects the actual value of the business as a whole. If it does, or if the business as a whole is worth more than this number, then that means that this number per share is potentially in line with what you would want to pay. Now, I prefer to find them at a discount. I'm just, people tell me that I like my my cigar butts because I look for discounts, and that's sort of a Ben Graham type thing where you find the cigar butts. It's super cheap, but there's still that one puff left in there for value. Now, I kind of reject the idea that the companies I buy are cigar butts that just have one puff. I mean, people have told me that that's how I'm looking at MPW, but the way I really look at MPW is, hey, this company invests in medical properties, and it's basically all hospitals. Though they have some, I think they have some like senior living facilities and maybe some mental health facilities. But basic premise, I don't think we're going to need fewer hospitals in the future compared to today. I think people will probably need hospitals for the remainder of my lifetime. And therefore, I think that owning that key infrastructure is probably on net going to play out well over a really long period of time. Now, there's some definitely short to medium term, potential troubles ahead. Oh, see you later, Eagle. That's exactly right. to shorten what I was going to say, yeah, a lot of cigar tubing left. They've got quite a few puffs left in them. They have to get through the situation right now with their tenants. So inflation has absolutely battered their tenants, right? Because they've had to pay those nurses and doctors probably more money to keep working, but the amount that they can bill Medicare, Medicaid is a lag measure. Like Medicare and Medicaid will eventually, raise payouts for things, but it's not like it's going to be the exact amount on the exact same time frame that they have to increase their labor costs. Or, hey, maybe supply chain issues have made certain supplies or devices, more expensive as well. And, those things are not inherent like flaws in the business model of their tenants necessarily. They're just, it's one of those stuff happens kind of things. And then interest rates going up are going to make it harder for them to service and or refinance on some of the debt that they've got. However, there were people that thought that 2008, 2009 real estate crash was a catastrophe that could never be recovered from. Now, if you had approached the stock price decline on a company like MPW the same way back then and said, hey, hospitals are going to be around for a really long time, this is probably going to be okay, you could have picked it up for like $3 a share back then. And that would have been great. Even at today's current drop in share price, would you really care about it being like $8.59 a share if you had gotten in at $3 a share after that really, really bad crash back in the day? And yeah, you would have had to endure a bit of a dividend cut or whatever temporarily, but now the dividend is, higher than it ever was back then. And yeah, it's taken time, but, be patient, People, I feel like a lot of people only see things like quarter to quarter. Oh, this quarter this happened, the Fed said this last week. What are they going to do next week? But if you think in really, really long time frames, 10 years from now, 20 years from now, and what have you, are hospitals going anywhere? No. Yes, a few of the tenants for MPW might have problems. They might have some issues with their interest rates. But, they did survive, 08, 09. They did have a dividend cut at one point, and the share price collapsed, but they ended up bouncing back, and they, I think, ended up in a better position eventually, right? So even if this ended up being like a 2008, 2009 situation, which really I don't think it necessarily will be, it's kind of a totally different beast. We had, this pandemic that kind of shook things up and everything. I just don't think that, it's definitely, there's definitely issues going on right now, right? But the fact of the matter is that I don't think I don't think fear mongering really accomplishes anything. And yeah, John, like you say, the old Buffett quote, "Be greedy when others are fearful." That's exactly right. If you can, take your emotions out of it and just look at the value proposition. Yeah, that's exactly right. Yeah, the current share price is just, what somebody was willing to pay for it on a day-to-day basis, right? Today, that's the price somebody will pay for that right now. However, yeah, in the long run, what people will pay for something will tend to correlate with how it performs financially and, what it produces for them. But yeah, in the short term, like the Meta example, people didn't like the legs in the metaverse, so it was at $88 at one point, right? And by the way, I was selling puts back then. Maybe I should show proof of that sometime. Now, look at this. So I was selling puts here because I said that price made absolutely no sense. Okay. It was just flat out irrational. I think this is about the time legs and the metaverse and whatever happened, and boom. Like, how silly is this? And this is why I don't think that the market is efficient, right? Are you telling me that it was efficiently priced in May at $223, but also efficiently priced in October, November in the low 90s or high 80s, but now it's also efficiently priced again now that it's back to $220? No. This is just stupidity. This isn't efficient. This is just people putting buy and sell orders based on how they happen to feel that day. So guys, I'm going to wrap it up here. We've been at it for over an hour. The time started to fly once the chat started coming in. Appreciate you. Take it easy. Have a good weekend. Oh yeah, by the way, like, comment, subscribe, join Discord. I don't self-promote enough. I always forget to say that stuff. Take it easy, y'all. Have a good weekend. Signing off.